So here's where the problem lies. Because interest rates have gone up as of late, the bonds that they held and bought over the last few years are now worth significantly less.
So I sat down with Jaxon Hughes from Fulcrum Home Loans earlier this week to chat about the latest in the Boise housing market. And he also gave a clear explanation of what led to the collapse of the Silicon Valley Bank in California and how that whole ordeal has affected the mortgage rates recently. What have you kind of seen over this past year from a lender's perspective, sort of in the Boise housing market?
Yeah, I mean, definitely volatile times, right? And you probably know the numbers better than I do even. Something that I've been seeing as of late in the last month and a half, I work with a good portion of first-time home buyers, and in the price range between, call it $350,000 and $425,000, kind of that starter home range that we see in the Treasure Valley. There's been a lot of pickup in the market. Had a buyer who just made an offer, and there were 15 other offers on the property. And they didn't get that one, made another offer the next day, and they also had 4 offers on it. So seems like, at least from my vantage point, that it's picked up in that range. Have you seen?
For sure, yeah. I've actually spoken to a number of agents over the past month and a half or so, and everybody said the same thing. Definitely seen an increase in activity, which is interesting because sales are down 30% year over year here in Ada County, and the interest rate has more than doubled in the past year and a half, and so we really hit a slump last year, right? Especially kind of from June through the end of 2022. But really in the first month and a half, well, let's call it first February and half of March, let's say, it's really increased where usually it's kind of still a slower time of the year. So just this past weekend, I listed a house and it sold over the weekend. Let's talk a little bit about what has been happening this past week with the banks. That's the big news, right? Silicon Valley Bank kind of went belly up. What happened sort of on the bank side of things that led to this meltdown of this bank here in California?
Yeah, unfortunate news. Let's say we are clients of Silicon Valley Bank and we go deposit $10,000 with them. The bank isn't just holding that $10,000 as cash in the back, right? They use that money to go invest in different assets to get some sort of return. So what happened was, over the last few years, they were using their clients' deposits to buy primarily government bonds. And as we know, interest rates have been super low over the last few years. So the bonds that they're buying are yielding a minimal amount. On average, I think it was 1.79%.
Wow. And so just a bond, just to be clear, basically a bond is an IOU.
That's
right?
correct. Yeah.
So I, the bank, give you $10,000, and so I have an IOU from you from $10,000, and you say you'll pay me back, or you'll pay me $10,000 and some interest over the 5 years or so.
Yeah, if it's over 5 years, I'll pay back that $10,000 at the end, and each year I'll give you a certain amount of money based on whatever that interest rate or yield is.
And so the bonds that the banks were holding had a yield of about 2%, let's say 1.75%. And how did that play into the collapse of the bank?
Yeah, good question. So they're holding these low yielding bonds, and there were some worries that the bank had some liquidity problems. So more and more people were going to take their money out of the bank. In order to pay those people back, the bank has to sell the bond, sell that IOU for cash to pay them back. So here's where the problem lies. Because interest rates have gone up as of late, the bonds that they held and bought over the last few years are now worth significantly less. Let's take 2 different bonds here. One yields 1.5% and one yields 3.5%. Am I going to pay $500 for each of those?
Right. No, you take the higher one.
Right. I'm going to take the one that yields more. So when me and you go back to the bank and say, hey, we want our $10,000 back, and they go to sell that bond, they have to sell at a major loss because of where interest rates are at right now. And as more and more people ran to the bank to get their money out, they couldn't pay everyone back, and that's why they went.
So what is this going to do for the housing industry, for the mortgage rate?
Yeah, so at least as of the last week or so, the market has shifted into thinking that the Fed may not increase interest rates as much as they previously thought. And the reason for that is if the Fed, or the thinking behind it is, if the Fed keeps increasing their interest rates, more and more banks could be
insolvent,
face this same problem. And so because of this market sentiment, we've actually seen interest rates drop by about 0.5% in the last week or so.
Right. And so is that going to keep coming down?
We don't know. No idea.
We don't know, right? I mean, when it comes to timing the market, it's nearly impossible, if not impossible, to do that because you never know. Have you hit rock bottom, or is it going to go back up? Is it going to keep going down? Time in the market is better than trying to time the market.
Absolutely.
Cool. Thank you, Jaxon, for being with us. Great chatting with you. And stop by again and join us again in the future.
Will do. Thanks, Benj.